17, taxes affecting real estate. Key term review. Adjusted basis is the owner's original cost plus buying expenses and capital improvements. Adjusted basis. Ad valorem means taxed according to value. Ad valorem. Assessed value is the value of a property for property tax purposes. Assessed value. Assessment limitation, save our home's benefit, is the accumulated difference between the assessed value and the market value of a homesteaded property due to the annual limit on increases in assessed value. Assessment limitation. Boot is an additional capital or personal property included in a like-kind exchange. Boot. Capital gain is profit from the sale of property. Capital gain. Debt service is the amount of money needed to meet the periodic payments of principal and interest on a loan that is being amortized. Debt service. Depreciation is a key deduction when calculating taxable income from investment property because it reduces taxable income without requiring a cash outlay. Depreciation. Exempt properties include property belonging to churches and nonprofit organizations. Exempt properties. Green Belt Law was designed to protect farmers from having taxes increased just because the land might be in the path of urban growth. Green Belt Law. Immune properties are city, county, state, and federal government properties. Immune properties. Installment sale method is a way to report gain for income tax purposes as the gain is from the sale of investment property. Installment sale method. Just value is the fair and reasonable value based on objective valuation methods for property tax purposes. Just value. Like-kind exchanges allows investors to defer paying taxes by exchanging real property. Like-kind exchanges. Long-term capital gain. Broker, forget it. Mill is 1/1000th of a dollar or 1/10th of a cent. A mill. That's 1/1000th of a dollar or 1/10th of a cent. Special assessments are one-time taxes levied on properties to help pay for some public improvement that benefits the property. Special assessment. Taxable income is the amount of income that remains after all applicable deductions and adjustments are applied. Taxable income. Taxable value is the non-exempt assessed value that is determined by subtracting the applicable exemptions from the assessed value. Taxable value. Tax rate is the millage rate multiplied by taxable value to determine the annual property taxes due. Tax rate. Key concepts. Real property taxation process. Property taxes are ad valorem taxes according to value. Assessed value of all properties within the county. It's levied on a calendar year basis. It's paid in arrears at the end of tax year. It becomes a lien on January 1st each year. Property tax liens are superior to any other lien regardless of date. Steps in protest procedure. Contact the county property appraiser's office within 25 days to seek an adjustment. Appeal to the Value Adjustment Board. Litigation. Property tax exemptions. Immune, government. Exempt, churches and nonprofits. Partially exempt, homesteaded property. Homestead tax exemption. Florida residents who hold title to a home in Florida and use the home as their permanent residence may homestead the property. Calculating homestead exemption. First, $25,000 of assessed value. $25,000 exemption from city, county, and school board taxes. Assessed value of $25,000, $1 up to $50,000, no additional exemption. Assessed value between $50,000, $1 up to $75,000, is a $25 additional exemption from city and county taxes only, applied to the amount of assessed value that exceeds $50,000. If the assessed value is greater than $75,000, a $25,000 exemption from city, county, and school board taxes, and $25,000 additional exemption from city and county. First-time applicants must file for homestead by March 1st. There is an additional $500 exemption on homesteaded property for widows and widowers, legally blind persons, and non-veterans who are totally and permanently disabled. $5,000 disabled veteran exemption is for veterans who are at least 10% disabled by military service-connected injury. Greenbelt law shields agricultural property from higher tax assessments. It's designed to protect farmers from having taxes increase just because their land might be suited for development. The Save Our Home Amendment caps how much the assessed value of homesteaded property may increase each year to 3% annually or the CPI, whichever is less. Tax rates. Cities, counties, and school boards are capped at 10 mills each. 1 mill is written in decimals as .001. Taxable value multiplied by the tax rate equals annual property taxes due. Again, taxable value multiplied by the tax rate equals annual property taxes due. Special assessments, a one-time tax on improvements such as sidewalks, street paving, and so forth. The law requires that improvements benefit the property by resulting in increased value. It's calculated on per foot cost of the improvement. Non-payment of property taxes. Property taxes constitute a lien superior to all other liens on real property. Property taxes become a lien on January 1st of each year. Property taxes for the previous year become delinquent on April 1st. Tax certificates are issued for each delinquent property. Tax certificate auction, redemption of tax certificates, and tax deed process. Tax advantages of owning a principal residence. Mortgage interest, property taxes, IRA withdrawals for first-time homebuyers, exclusion of gain from the sale of a principal residence, additional tax benefits to homeowners. Interest on home equity loans is deductible. Mortgage origination fees are deductible. Sale of real property. Adjusted basis, amount realized, exclusion of gain from the principal residence. Purchase of real property from foreign sellers. Nothing's there. Investment property. Types of income, determining taxable income, debt service, and depreciation components. 3 deductions from taxable income on investment property are operating expenses not reserved for replacements, financing expense, and depreciation. Key to sheltering income from taxation is depreciation. Straight line method of depreciation for investment real estate. 27.5 years for residential rental property, 39 years for non-residential income producing property. Depreciate the structure only, never the land. Depreciable basis of property is the initial cost of the asset plus acquisition cost minus the land value. Capital gains and losses. Tax on gain at time of sale, installment sale method, and like-kind exchange. Important dates and time periods to remember. January 1st, date each year that property taxes become a lien on real property. March 1st, last day for first-time applicants to file for homestead exemption. April 1st, property taxes from the previous year become delinquent. 27.5 years, useful asset life for residential rental property. That's 27.5 years. 39 years, useful asset life for non-residential income property.